Interest rates have been dominating headlines, have been dominating discussions for months now, thanks to the action of central banks in hiking interest rates, up to the point that we are now wondering whether we are close to the peak in official interest rates. To discuss this topic, we'll have a conversation with Hélène Baudchon. We will analyze whether in the eurozone and in the United States we are close to the peak in interest rates, and we will also discuss what have been the consequences of past monetary tightening on the growth and inflation outlook. Then I will have an interview with Richard Malle. He's heading our real estate research team at BNP Paribas, and he will talk about what has been the implication of rising interest rates on real estate as an asset class, and in particular also going into detail of the different segments of real estate. And finally, I will have a conversation with François Faure of our country risk team, and the discussion will all be about rising interest rates in the United States, what has been the impact, if any, on developing economies, and also what will the future bring? How can we explain that some developing economies have already started easing policy? Lots to discuss. I thank you for joining us, and let's now get started. Hélène, hello.
Hello, William.
You are a deputy chief economist and you're heading the OECD team. So, immediately come to the key question, which is, are we at a peak in interest rates?
Well, we can hope so in the United States and also in the eurozone. This is at least our base case. But so far, at the moment of our talk, it is quite difficult to be sure at 100%. Indeed, we have signs.
It's highly likely.
It's likely, but I cannot be sure, fully sure, because we have signs of deceleration in inflation, in activity, in the labor market too. But these signs of deceleration remains quite limited so far, and therefore insufficient, in our view, to clearly shift the balance in favor of another rate hikes, or in favor of status quo. And what argues in favor of status quo today, according to our view, is the long lags of monetary policy transmission. And these lags call for caution in order to avoid over-tightening. And that makes me think about another question with regard to this right degree of monetary policy restraint, with regard also to the resilience of the US economy in particular. Is it possible that the Fed is about to succeed engineering a soft landing of the US economy? William, what do you think about that?
Well, it's a distinct possibility. It clearly was the hope at the beginning of the tightening cycle. I think any ambition of a central banker that is raising interest rates is to achieve this soft landing, which is pretty unique in history. The only one that we have experienced in the United States was in 1995. Alan Greenspan tightening policy very significantly in 1994. And guess what? The economy slows, inflation converges to the target, and they could stop with their monetary restraint for the time being. It's really too early to say. Markets analysts talk about soft landing likelihood because they see the resilience of the labor market and they hope that inflation will go down. But that really means that the confirmation of a soft landing very much depends on the dynamic of inflation. And headline is down, but what about core? What will determine whether we will have sufficient degree of decline?
In fact, we indeed have signs of a quite sharp decline in headline inflation in the US and in the eurozone, but for now this is mainly due to the fall in the energy component of headline inflation. So this is a necessary but not sufficient condition. In the eurozone, in particular, food inflation continues to play a quite important role. It explains about 40% of headline inflation. In the US, this is 20%. So the missing ingredient so far to observe a sharper fall in inflation, this is the one of core inflation, which remains elevated. Why that? Because of the stickiness of inflation in the services And behind this stickiness of inflation in services, this partly reflects, at least partly indeed, the resilience of growth. So it brings
which gives pricing power to companies.
Indeed, but that's a problem regarding the fight against inflation. And in fact, it brings me to another question. Maybe the peak in policy rates has been reached, but what can we say about long-term rates?
Yeah, well, bond yields have been very sensitive to economic data as of late, and that is pretty understandable because we are so close to the peak in policy rate. That means that any evidence, any comment of a central banker that would force markets to revisit their central scenario of we are at the peak, but it forces bond yields higher. We've seen that in the summer with the release of the minutes of the FOMC in the United States, more hawkish than expected, so it pushed up bond yields. But I think when we take a step back and we look at the broader trend for the months to come, one, it is very clear that inflation expectations in bond markets are very much under control and are stable. So it all depends on what monetary policy is going to do. When we will see that without any ambiguity we are at the peak, markets will start to anticipate that in the course of 2024, the Fed will cut rates, the ECB will cut rates, and that means that over that time span, bond yields should gradually drift lower. Now, when you look at it from that perspective, you could almost argue, oh, wait a second, we have a soft landing, we have the peak in policy rates, bond yields trending lower, it's fantastic. Going back in time, doesn't this give any recollection of Goldilocks?
I'm not so sure. I would say this is desirable, but I think this is quite unlikely because what has been called Goldilocks was a very special period, a unique combination of strong growth with no inflation. A major feature of that period was also the emergence of new information and communication technologies, which has led to strong productivity gains. Today, we indeed have a strong wave in green investment and also in AI investment, but can this current wave of investment help support growth and contain inflation like in the second half of the 90s? In the longer run, perhaps, but in the near term, not immediately, I would say, because there is still a consensus to be built on that subject.
In terms of productivity, you mean?
Yes,
That's
in terms
really
of the positive impact on productivity of this wave in green investment and AI investments too. And we also have to have in mind that the current cycle is very particular, with particular dynamics in wages and margins, and the moderation of these dynamics really determine the convergence of inflation towards the 2% target. So, in other words, the chance of returning to a Goldilocks type scenario seem slim to my mind. The favorable conditions are very uncertain. All the more so as if we continue on uncertainties and downside risks to growth. I think we also have to take into account possible non-linearities, in particular regarding the reaction of economy to the monetary tightening. So what do you think about these non-linearities?
Yeah, well, definitely a topic that we need to keep in mind, because up until now, you could argue we're kind of in a linear world. Linear world, that means that we have a gradual loss of momentum in the labor market, slower pace of job creation. All in all, a very limited increase in the unemployment rate in the United States. Business sentiment is going down, but it's not collapsing. So the non-linearity is when suddenly it would really become almost an eruption of negative sentiment. So what could be the cause, the trigger? Well, the trigger would be, the candidate would be that companies end up realizing that they have been too optimistic in the assessment of future demand. If they would come to that conclusion, that would mean that they would stop hiring people. They may even let people go. That would have a knock-on effect on household confidence, would have a knock-on effect on spending. So that's one candidate kind of realization, my goodness, we've been too optimistic. And that same candidate you also find in financial markets. Financial markets have been in a risk-seeking mode in this cycle, risk-on sentiment. And if it would turn out that equity investors realize that they've been too optimistic in terms of the profits outlook, they would also revisit their position, and that would cause the equity market to go down. It would also cause a widening of spreads in the corporate bond market. So that's really the kind of the two sources of risk for a nonlinear development. It's quite fascinating actually to see that you have discussions amongst economists between soft landing and Goldilocks beast on the one hand, and on the other hand, nonlinearity. So I would say that, and I think you will agree, it gives us a lot of items on our research agenda, and together and with your team we will cover that in our publications and our videos. So thanks for this exchange of views. And then I will now turn to an interview with Richard Malle of our real estate business of BNP Paribas. Real estate is a sector that is very much dependent on interest rates, so I'm really keen to learn what he has to say about what the impact of interest rates has been on the outlook for his sector. Thank you. Hello, Richard.
Hello.
So, important topic, interest rates, and what is happening in the property market, in particular in commercial real estate. What's your take at the situation?
Commercial real estate market has been greatly affected by the rise in interest rates, and especially via a dual effect. The first point is the rise in short-term interest rates. It's an issue because investors, especially for professional investors, have the credit with low interest rates, and they could use before leverage to target high property returns despite low rental yields. This is the first issue. Second issue, investors compare long-term interest rates with property yields, and the rise in government bond yields make less appealing real estate market compared to obligation. It's the two main points, and that's why we have a decrease in prices since 2022 for commercial real estate.
So in a way you have a scissors effect, because on the one hand the necessity to go in real estate to capture yield has come down, but the possibility to do that via leverage has also come down.
Yes, absolutely. And this is the issue, and that's why 2002, 2023, it's a period on downturn in the market, and maybe recovery then after.
Yeah. Now, another attention point, of course, is what is happening to cash flows, and then you think about the overall slowdown of the economy, globally speaking, but also in particular in the eurozone. So is this growth slowdown something that is also weighing on the commercial property market?
Yes, it's safe to say that economic growth is slowing, but it's relatively robust given the situation. That's why the job market is healthy. We don't have any significant decrease in terms of job. That's why the office demand is relatively well given the situation. But of course, we have the surge in remote working. It's have an impact relatively important, especially for occupied space from large tenants. It's an important point. And the consequence, it's very visible on suburban area, and sometimes we have a lack appeal. It's the first point. Second point, for the best location, such as the central business district, we have still low vacancy rate. We have a high rents, because for tenant and talent retention, we want to be in the best location. So it's very sought after, and we have very two situations, a wide range of situations between the periphery and the central location. And last but not least, inflation leads to higher rent, which offsets partially the decrease in prices.
With respect to the office market, would you say that the effect of working from home is now priced in and that it is stabilized, that you do not expect any major changes there? Or
I could see it depends on location. And we can have a positive and a negative impact. We have positive impact in central business district because we want to be in the best location to attract and to retain best talent. It's the first point. But in a periphery, in suburban area, the situation is more challenging, depending on location once time again, and the decrease in values, in rent and prices could last a while.
Yeah. We've talked about the office market. There is the prospect of more subdued consumer spending growth. Is this going to have an impact on shopping malls?
Yes, we have an impact, but I would say that the impact, the decrease for shopping center has not started in 2022, more started in 2015, 2016. That's why now we could have a stabilization, a leveling off in prices for shopping center, and why not a recovery from 1 or 2 years in the future, one times again, depending on location.
Yeah, and then a third segment is, of course, logistics. I'm not the expert, but I would say that must be the upward trend that continues.
Yes.
Do you agree?
For logistics, demand has been very high, especially since COVID, since 2020. The demand is still robust and will be still robust for the future, but we have a decrease in prices recorded since 2022, with the impact in increase in prime yields.
We've talked about commercial real estate. Now, of course, most people are even more focused on what is happening to residential real estate, where the link between the cost of financing, mortgage rates, and the access to the property market is obvious. So what's your view there?
Yes, for the housing market, the interest rate shock is passed on via mortgages. But it depends on countries. The most important decrease we could have, it's, for example, in Germany or in Nordic countries as Netherlands, Denmark, Sweden, with a double-digit drop recording since 1 year. It's the first point. But we could have market countries more resilient, such as Italy or Spain. In France, it's especially in the main cities, such as Paris, Lyon or Bordeaux, we could have a decrease significant. But we have 2 factors come into play to maintain high prices. The first one, it's still inflation. We could positively impact the revenue, the income of household, and so the purchasing capacity to borrow is the first point. And the second point, it's that many households have been moving from expensive location to cheaper ones. And that's why a scenario at 10% in terms of decrease in prices all in France is possible for the moment.
Yeah. In other countries, you also observe that the long-term projections about housing demand show an ongoing increase in housing demand. I suspect that France is not an exception to that.
Yes, definitely. We have a positive projection in terms of population, in terms of households, and that's why the demand for housing is important. But it could depend on location and type of houses.
You mentioned the word location on a number of occasions at school, talking about real estate. You learn it's location, location, location. Should we now add to that footprint, thinking about the carbon footprint?
Yes, of course, and it's speeding up the obsolescence of buildings, and also it's widening the gap between asset values, both in commercial real estate and also in residential. We could say that France is ahead of the field in terms of regulation in Europe, especially for letting homes with poor efficiency energy. It's the first point. Second point, and it's a striking point, because some 2 figures we could share. The first one, it's that out of 30 million residences in France, over 5 million have energy diagnostic at F or G. It's a point important. But for commercial real estate, it's the same situation. 63% of buildings for offices in Greater Paris is over 20 years old. That's why, for the long term, we are in a period of reconstruction, of heavy refurbishment ahead of us.
Yeah, it's very important what you mentioned because for us macroeconomists, we take that into consideration when we make long-term projections on GDP growth and investments in real estate. I would like to finish this conversation by having a quick look at the crystal ball. Our base scenario about interest rates, official interest rates, is that next year we will see the start of an admittedly slow process, but nevertheless a start with the Federal Reserve starting to cut interest rates and then followed by the ECB. So what I'm interested in is how do you assess the inertia between interest rate dynamics and then what is happening in the real estate sector? So can you say something on that?
Yes, we just saw that interest rate is very key in the forecast for real estate, both for residential and commercial real estate, even if it's different in terms of ways of impact. If we could expect a decrease in interest rates from 2024, we should have a delay from 6 months to 1 year, depending on markets, to have an effect in the residential and commercial real estate. That's why we could have a positive impact of a decrease in interest rates for a commercial and residential property, but not before 2025.
Okay, so we'll keep that in mind. We've had the pleasure of having you on the program already on several occasions in the past.
Thank you.
Thanks again for joining today, and let's already take our agendas and fix an appointment within a couple of months' time to bring us an update. In any case, many thanks for having joined us, and I would say let's discuss this further. Many thanks.
Thank you.
Hello, François.
Hello, William.
You're in charge of the country risks team. So in that role, when you were seeing that the Federal Reserve was aggressively tightening monetary policy, that must have created some unease.
Yes, indeed. Well, it's always the case because we know that when the Fed tightens its monetary policy, there is a risk of what we call the sudden stops. I mean, the fact that foreign investors move their investment outside emerging markets. Well, since the last US monetary tightening, it was not a big deal for emerging countries. Well, according to the IF estimates, when you look at foreign investments on the emerging bond markets, those investments remain quite sustained, about $13 billion per month, which is more or less the average over a much longer period. And this is not to say that there is no sudden stop, but there is only a few countries that experience a sudden stop. And when you look at econometric studies on the impact of the US monetary tightening on monetary tightening for the other emerging countries, there are only a few central banks that follow suit, mainly in South America, for instance, Mexico and Colombia, but also South Africa and Indonesia. But that's all. So not so many central banks follow suit the Fed. And last point, if you look at the 5-year CDS spreads, which is a measure of country risk premium, well, they have increased obviously since the beginning of the US monetary tightening, but not that much. And when there was a surge in such risk premium, it was for country-specific reasons and not because of the Fed tightening.
So on the whole, we can say that international investors have been quite relaxed about staying exposed, remaining invested in developing economies' bond markets. So what explains this relaxed attitude in your view?
Well, I do not say relaxed, but because there was up and downs. But I think that for foreign investors, generally speaking, central banks and also the governments have followed quite relatively orthodox economic policy. So investors were happy to observe that there are someone behind the wheel and for the good.
And driving in the right direction.
Yes, especially in this very erratic period of pandemic and post-pandemic and so on, which is a very specific period.
Now, what's fascinating in the universe that you cover, whereas in the advanced economies, all the debate is about, are we at a peak in policy rates, yes or no? In your space, you already have countries that have cut interest rates.
Yes, but there are only two countries, which are Chile and Brazil. But for those two countries, growth was very low, and in Chile, actually, this country is experiencing a recession over the last 1 year and a half, and in Brazil, growth is very low. So it's normal to have, and obviously, inflation has decelerated over the last months. So it was normal for this country to relax the monetary policy. But for the other emerging countries, I think that central bankers will be very cautious in relaxing monetary policy because first there are some countries, for instance, in India, where inflation has already accelerating during the summer. The second point is that oil prices, but also food prices, have rebounded during the summer, so this will have an impact on inflation. And the third reason is that for, I would say, many emerging countries, labor markets show very low unemployment rates and in some cases very, or at least relatively high wage inflation. It is the case for Poland, Mexico, and again for Indonesia.
Now, we haven't yet talked about China, and China has been grabbing headlines over the summer months with the problems in the real estate sector that became worse and worse. It's also a country with very low inflation. So you could say, well, if you have a real estate problem and low inflation, cut rates. So what's your take on that?
Yes, but it is the case, but Chinese authorities have done this very progressively because they have to balance the need to support activity and the need to preserve financial stability. So over the last year and again this summer, they have taken some measures in order to support directly the real estate sectors. So they cut again the policy rates, both the rates that are benchmark for the bank lending rates and also the rates for the interbank market or the money market rates. And also they have taken some measures in order to specifically support the mortgage markets. So the lending rules have been relaxed, and again, the rates for mortgage, the banks are now cutting the rates they offered for mortgages. But having said that, as always, for many years now, first, when you look at those measures, they are limited themselves because first, monetary authorities have to be very careful because they have to support the banking sector. So they try to not decrease the interest rates too rapidly. And the second fact is they want to have the control on the depreciation of the renminbi, which is a good thing for export, but not for inflation. And the impact of the regulatory measures themselves is limited as well, because more generally speaking, there is a confidence crisis in the Chinese economy. And the second, there are indebtedness, especially for local governments and obviously for the real estate sector. But we don't believe that China is experiencing a Lehman moment, in the sense that leverage is mainly concentrated on the real estate sector and not on the other sectors. Mm-hmm. But cross our fingers, and we hope that this smooth policy, both in terms of monetary, we are talking about since the beginning of this interview, but also on the fiscal policy, they are very cautious, and they take measures very progressively, not in order to not create disruptions in the economy.
Yeah, you can argue that the Chinese balancing act has an importance that goes far beyond the borders of the country. Now, when you look at the countries that you're covering with your team, China, low inflation, with real issues that you have described. And then on the other hand, on the other side of the spectrum, you have a country like Turkey with lots of inflation and big policy rate increases. So what's going on there?
Well, it's very specific story, what is going on in Turkey, because for many years, in terms of monetary policy, Turkey was the outlier. And it is also the case now because the policy rate have been increased from 8.5% to 25% in over 1 month, 2 months or so. The reason is that there is a U-turn in monetary policy following the elections that won by President Erdogan, but there were changes both at the head of the central bank and at the head of the Ministry of Finance. The fact that there is a U-turn in monetary policy is obviously to try to contain inflation, because even if inflation has decelerated in the first part of this year with the Turkish lira depreciation during the elections and post-elections, inflation is expected to re-accelerate during the summer. So that's the reason why, basically, monetary policy have been tightened. But so far, so good, because when you look at bond yields or risk premia, as I mentioned in the first part of this interview, it was under control. There was not a blow-up, financial blow-up inside Turkey. And what is important now for the Ministry of Finance is to achieve a very touchy balance between the fact that inflation must be reduced and the fact that there are local elections next year, municipal elections, which are very important for President Erdogan. So not to tighten the fiscal policy too much, but they will have to do this because the budget deficit have increased a lot, mainly because of expenditures ahead of general elections. But again, cross our fingers. I don't think that Turkey will experience a recession and even less a financial crisis. I think that the Ministry of Finance is trying to find a balance for the economy to not turn into a financial crisis or lack of external liquidity, or some people say the help of the IMF. It's not on the paper nor in my view of the country.
Well, that's reassuring, because looking from outside, there were question marks at some point, and so what you said is reassuring and is comforting. Well, thank you for these insights.
You're welcome.
A large number of topics. With your team, you continue to cover this in videos and publications, in particular Eco-Emerging, which is a fantastic product. I thank everybody who has followed this special episode of EcoTV. I invite you to join us on a frequent basis for our weekly publications, our weekly videos, EcoTV Week, and also please visit our website, where you will find lots of detail on a broad range of economic topics. Many thanks and see you soon.